Welcome everybody to Safe Option Strategies presentation of earnings. This class is a production of Safe Option Strategies and the content is protected by copyright. Any reproduction or redistribution of this or any Safe Option Strategies presentation is strictly prohibited by law. The information presented in this class is for education purposes only. Safe Option Strategies does not make any recommendation to buy or sell stocks or options. Trading stocks and options comes with risk and you are solely responsible for any losses you may incur as a result of trading. All right. This is not a very long class. We may be finished with this material in 25 to 30 minutes. I let you know that at the beginning so that you don't feel disappointed if we're 30 minutes in and we're wrapping things up. Some of our classes definitely go a lot longer than that, as you saw in the previous class. The purpose of this class, I used to include this class with another one, and it would turn into kind of a long class. It ended up being over an hour. And a couple years ago, maybe a year and a half ago, I decided to separate these and make them into two different classes. I'm speaking of earnings, I'm speaking of market sentiment and sentiment analysis. Earnings is important, and I oftentimes, it's probably not the most common thing that I run into, but oftentimes I run into a situation where people have taken some big losses or people have struggled with something, and it's very directly tied to earnings. Either they thought they knew what was going to happen post earnings. They were going into an earnings report on a company that they were trading, whether it was a trade with the stock ownership, whether it was a spread trade of some sort. They get to earnings and they think they know what's going to happen post earnings. And so they play something directional through earnings. Or quite honestly, they're trading the stock, or they've got some type of an option trade on. And maybe they don't forget that earnings is coming along, but maybe they forget that earnings can have the kind of impact it can have on the price of the stock. And in some cases, they do lose track of earnings. The reality is, when you get beyond the name of the company and what their industry is and who their competitors is, those are all things that we do in fundamental analysis. When you get beyond the fundamental analysis and you're talking about the price of a company's stock, there are a few things we know. One thing that's so important is we know that we don't know anything at all about what the direction of the stock is going to do. Every move we make in the market, you've heard me say this before, you're going to hear me say it again. Every move we make in the market in some way, shape, or form is based on an educated guess. We take all the data we have at our disposal and we make the most educated guess we can make in trying to figure out, what is this stock going to do now? What is this company going to do now that we've analyzed it? And it's an educated guess at best. We don't know tomorrow what the stock market is going to do. We don't know what any individual stock is going to do price-wise. We have a lot of data available to us to help us analyze that. We covered a lot of that in technical analysis in the previous class, and we know the tendencies of companies and how financially sound they are, how healthy they are, etc., but we really don't know what they're going to do. We do know for certain when the next earning event is. Now, sometimes there's a tentative date, and we have to get a little closer to that date before a company will lock in and give us the exact date, but we know when the next earnings event is. Every piece of information we know adds to that cumulative, educated guess. We want the educated part of the term educated guess to be the bigger part than the guess part. And so we know when that next earnings event is. We also know, if we're picking the right companies, that the earnings event is the most likely thing to change the direction of the stock in terms of, and let me put this in perspective, it's the most likely thing that we know about. I think next time I do this class, I might change that wording on the bullet point, so I want you to make a note of it. It's the most likely thing that we know about that could change the direction of the stock. We don't know if some world leader tomorrow is going to declare war on the United States because of our new president-elect. We don't know that. If you're watching a recording of this, that's probably a giveaway on approximately when this was done live. We don't know if something catastrophic is going to happen. Um, and there are a lot of things that could dramatically change the flow of the whole market or change the direction a company is going. We know when earnings is, and we know that that is an event that could change the direction of the stock. Okay? Let's talk about what a typical earnings report involves. Earnings, for those of you that, and there are some people, some students that come to me and come to this education and they are brand new to the market and possibly trading for the first time ever in their lives. For a lot of you, this is going to be very elementary. For some of you, it'll be valuable information that you're learning about the first time. Every publicly traded company in the United States has to report their earnings once per quarter. They have to give an accounting to their shareholders 4 different times each year on things like revenue, things like profit, expenditures, and most of them give additional information beyond that. But a typical earnings report includes a report on the total sales or revenue that a company experienced. That is oftentimes referred to as top line. When you hear a news commentator, or you hear, or you're reading something or listening to something on the radio on CNBC or Fox Business or Bloomberg Radio or something like that, and you hear someone saying, they beat expectations on the top line or they beat expectations on the bottom line. Top line is how much money is coming in. How much money is coming into the company before any of the cost of doing business, before any of the expenses, what's coming in. Then you get a report on profit. How much profit was made. And when they divide that profit by the number of outstanding shares, these two things really tie into each other closely. These two really tie into each other, but the bottom line is considered how much profit was there, how much earnings were there per share, and that's just taking the profit and dividing it by the number of outstanding shares. And that's where they come out with the earnings per share. How much did we earn per outstanding share of stock? And this is what's referred to as the bottom line. Now, sometimes companies will do well on the top line, but expenses were high and they won't do very good on the bottom line. Other times they'll come up a little bit short of what people thought they were going to hit on the top line, but their bottom line looks really good because maybe they cut some expenses along the way somewhere. Now, it's becoming more and more common that companies, or if not the company themselves, the commentators and the analysts who break it all down for us, are starting to talk more and more about organic growth. I have heard a lot more about organic growth in the last few years than I used to hear when it came to earnings report. I'm going to talk in a minute about what organic growth is. This is not required. The SEC does not make any publicly traded company do this. The SEC doesn't require that they give any commentary themselves on organic growth, and they don't require that they give a guidance or an outlook statement. However, most companies do. And if the company does not, probably there are a lot of analysts who will tell you what they think their guidance and their numbers should be for the next quarter. It is not required that a company give commentary or a statement or a definitive number on their guidance or their outlooks. Guidance means, we had revenues of $3.5 billion last quarter, and a guidance statement would say we are projecting revenue of $3.9 billion next quarter. This would be a guidance statement. The company is under no obligation to produce this number, but they'll let shareholders know what they think they're going to do in the next quarter or in the same quarter next year. Sometimes a guidance statement will be for an entire upcoming year. Okay, let's talk about each one of these things that makes up the earnings report. And the reason I think it's important to know this is because after an earnings event takes place, a lot of the companies that we trade, whether we're doing spread trades on them, whether we're doing collar trades on them, a lot of the companies that we trade will experience a big movement up or down following an earnings report. Knowing what the cause of that movement was requires knowing a little bit about the numbers that we're looking at and their relevance to the company, and it helps prevent a situation where maybe we are too quick to adjust our position following an earnings report. I'll give you some examples. Revenue. It doesn't matter what industry a company is. It doesn't matter what sector a company falls within. It doesn't matter if it's a service company, if it's a manufacturing company, if it's education, if it's an online internet company, if it's a retail company, a defense manufacturer. It doesn't matter. They have to have revenue. There has to be money coming in to pay the bills. Even a research company, even companies that are primarily focused on research and the majority of their money coming in is through grants, they still have to have money coming in the front door. If money's not coming in, there's no company, at least not for very long. One of the things that is important to us as investors, as traders, is there growing revenue quarter over quarter and year after year. A lot of times a lot of companies are seasonal. A lot of companies will have 1 or 2 quarters of the year that are bigger than their other quarters during the year. That's the reality of it. And that's a fantastic thing. Is the revenue growing quarter over quarter, year after year? A lot of times you'll look and see, is the revenue this quarter growing over the same quarter last year, because you don't want to compare this quarter to last quarter if it's a seasonal company that is vastly different. And is there enough revenue to manage the debt of the company? That's one of the biggest things you're looking about. A lot of companies, a lot of big companies have debt. There is little or no getting around a lot of companies having debt. Is there enough revenue to manage that debt? Is there enough money coming in to take care of that debt? That's one of the biggest things you should be looking at when you're analyzing a company and when you're reviewing their earnings. Huge difference between profit and revenue. Vast difference between profit and revenue. Okay? Revenue is the money coming in the door. Profit, and again, I know this is very elementary for a lot of you. Profit is what's left after all the expenses have been paid. And it's important to know, or at least have an idea. You don't have to know it down to the penny, and you don't have to hyper-analyze or over-analyze every single expenditure a company is making. The only person that's really going to do that is the CFO and the controller and the vice president of finance or whatever of a company that's going to get into the nuts and bolts of it. But it's a good idea for us to know where a company is spending its money. What are they spending their money on? If a company had a quarter that their expenditures seemed really high, but they settled a patent lawsuit that would be good for the company going forward, that's not bad news. That could have an effect of one quarter where stocks are down a little bit. But that's not necessarily bad news long-term for the company. So you've got to pay attention a little bit to what's going on in terms of where they're spending their money. Company that spends huge amounts of money on R&D, research and development, that might be a good thing, versus a company that's spending too much money on too many big salaries for dead weight that might need to not be there. And the profit ultimately is just after all those expenses, whether they're ongoing expenses or whether they're one-time expenses, what's left over after all of those expenses. That's where the profit of the company is coming from. Now let's talk about earnings per share, and this is where I'm going to get in a little bit to organic growth. This is where I also want to talk a little bit about organic growth. Earnings per share, like we said, the buyback. How many shares are outstanding? Sorry, I put on that word buyback and I didn't mean it. Earnings per share is simply how much profit was there, and divided by all the earnings, how much was each share worth, and you look for how much that grew from one year to the next. That's fairly easy to remember earnings per share. A lot of companies, when they find themselves flush with cash, when they have a really good quarter, a really good year, they tend to buy back their own shares. And when those shares are taken off the open market, it dilutes the number of shares. It actually dilutes the price per share, because each share that's still out on the open market for trade is now worth more money. We've had conversation a lot of times over the last couple of years about the Fed and the financial stimulus, and about how, we're printing too much money in this country. Every time we print more money in the country, it dilutes the value of every dollar that's out there. Every time we print another dollar and don't destroy one that's in circulation currently, we dilute the value of every dollar. The same thing would happen in reverse. If banks begin to bring back in and destroy all of the paper money that is past a certain year old or is in bad condition, we would increase the value of every dollar that's out there. Well, same thing happens with companies' stock. When they buy it back, fewer shares for public trading means that each share is worth more money. Now, organic growth factors out share buyback, and this is why it's important. A company could get away with making all of its investors think they had a really amazing quarter in terms of last quarter their earnings per share were $1.50, and this quarter their earnings per share is $4.50. That would look like impressive growth, right? And there are companies that have done that and have tried to get away with that, and because they don't have to report organic growth, it's up to analysts and it's up to the financial media and it's up to others to recognize the difference. Organic growth factors out share buyback. So when a company is taking its shares off the open market by buying them back, you need to dig into the numbers a little bit deeper and say, was the earnings per share so much better because the company did so much better, or was it so much better because the company did a little bit better, and with that little bit better growth or that little bit more revenue they had, they bought back a whole bunch of shares? It's becoming something that has to be watched more and more. Make sure you don't get fooled by a company that has a great increase in their earnings per share but has bought back a lot of their shares. It really boils down to, is there real growth in the company? Is the company really, truly growing? Okay, let's talk a little bit about guidance. All right. Does it matter if a company had a bad quarter last quarter if their outlook and their guidance is for legitimate reasons, not just because of optimism by the management, not just because they feel compelled to say something good? A good CEO, a good CFO is not going to try and fudge numbers on the guidance to make it look like things are better than they are. They can get in a lot of trouble for that, number one, and for the long-term growth of the company, for the longevity of the company, and for the long-term trust from shareholders, it's not a good thing. But which would you rather have? A company that has a bright outlook, or a company that made a lot of money last quarter, but they're going to struggle next quarter, and they'll admit to you through a guidance statement that they're going to struggle next quarter? Recently, at the time we're doing this class live, Facebook had a recent earnings report. Now, Facebook has made a lot of money. Their revenue is phenomenal. Their earnings per share was awfully good. They had a lot of positive things that they reported in their most recent earnings statement. But they also gave a warning. They guided lower going forward. They said, we think some parts of our business have peaked and might even fall off a little bit in the coming quarters in the coming year. And as a result, over the last, what's it been? At the time we're doing this live, maybe it's been a couple of weeks ago, a week and a half, 2 weeks ago, that Facebook reported, and they've fallen. The stock has fallen. And it hasn't tumbled in a huge way. They still made a lot of money, but it has fallen. A lot of times, guidance is going to be compared to what analysts are projecting. And if analysts are saying, we think Facebook should make $2 billion next quarter, and Facebook is saying, we think we're going to make $1.5 billion, Is $1.5 billion in revenue bad for the upcoming quarter? Of course not. I wish I had that stress to deal with. But $1.5 billion comes up short of what the analysts were projecting. Sometimes those numbers will be really close together and it'll be a little less relevant, and other times those numbers will be far apart. Who's projecting more? If a company is projecting higher numbers than the analysts are, you're probably going to see that company's stock go up. If a company is giving some numbers that are lower than what the analysts are projecting for next quarter, next year, you're probably going to see that stock go down. Guidance basically comes down to, what does the future hold? A question came in about this as it relates to a specific stock, and this is a good question. It's very apropos, and so I like the question. Didn't Smith & Wesson have things backwards? Good previous quarter and good projections. Consequently, the price has fallen. Yes. Now, I could take the easy way out of that question and say, hey, stuff happens sometimes that we can't explain. I won't do that to you. I don't believe in doing things that way. Everything that I'm sharing with you about earnings has one big giant factor missing, and that is us. That is you and I. We're the ones buying and selling the stock. And I include, when I say you and I, I'm talking about whether you've got a 5,000 in your portfolio or 50,000 in your portfolio or 5 million in your portfolio. What none of this factors in is you and I. We don't always, and we don't always collectively do what people think would be logical to do. And we live in a world of instant communication and instant news. We have instant news at our fingertips. Instant news at our fingertips. And sometimes that news will override what logically we think should happen based on earnings reports. So here we're saying, what are the analysts projecting and how far off are those numbers and who's projecting more? And that question came in right after I made the statement, if the company is projecting better future numbers than the analysts are, the stock should trade up. Doesn't always happen. It should. It oftentimes does. I would even tell you that more often than not it does. It doesn't always happen that way. Remember, knowing a lot about earnings doesn't change the fact that the trades we're placing are educated guesses. It's making the education better. It's being more educated in our guess than we would be otherwise. Does that make sense? In the case of Smith & Wesson specifically, we just recently had a presidential election. And because of who was elected president, a lot of people think that gun sales are going to go down. Regardless of what the companies have projected, regardless of what the analysts have projected, a lot of people think that gun prices or gun sales are going to drop off because our new president-elect has stated publicly that he's going to be a huge defender of the Second Amendment. The other side of the aisle has been pretty open, not just during the election and the campaign, but for a while now, for a lot of years now. The other side has been pretty open about wanting stricter gun control laws, making it harder for people to own guns, therefore making it a smaller group that gun manufacturers could sell to. Those are two very polarized, very, very opposite viewpoints. And so that's what I think happened specifically with Smith & Wesson. Bottom line with guidance and outlook is you're trying to get a pulse on what does the future hold. It's still a guess. Now, a little bit of commentary. I'll try not to get on a soapbox here. A little bit of commentary about analysts and analyst expectations. What does analyst expectation means? Here's the definition that came right off of Investopedia. Okay. Analyst expectations is a report issued by an individual analyst, investment bank, or financial service company indicating how a particular company's stock will perform in the coming quarter. Analysts provide guidance as to how they expect a company to perform. This is typically a range of values that a particular variable is expected to fall between. If a stock performs better than what analysts expected, it's considered to have beaten expectations or delivered stronger than expected results. And of course, the opposite is true. If stock performs worse than what the analysts expected, it's considered to have missed expectations. And sometimes you'll hear that termed as they beat the street, meaning Wall Street. Okay, so let me make some quick commentary on analysts and analyst expectations. There was a time, and it has been a number of years ago, there was a time when analysts ruled, and they still do to a degree. I want to say this in a way that's not as much on a soapbox as I have done in the past. In the past, I've really gotten on a soapbox and talked about how much I don't like analysts. And it's out of the bag now. You know that that's my feelings. I'm going to try and stay away from that and going off on that. Analysts sit in their office and they look, just like the title of their position suggests, they look at financial data from a company. They look at past data. They talk to people in the company. A lot of times a good analyst will have a direct line to someone, a controller or a CFO at a company, and they'll talk to them. They're not guilty of getting insider information, but they may sometimes have access to people that can give them information that you and I don't have. They look at all this data. They have complicated formulas built in Excel sheets and programs that have been designed specific for this with algorithms. And they punch in all their numbers and they say, okay, I think next quarter, based on all my data and all my research and everything I'm hearing from people at Apple, I think Apple should be able to bring in revenues of I'm making up numbers, by the way. I think Apple should be able to bring in revenues of $4.2 billion next quarter. And one analyst will say that, and another analyst says, well, I'm looking at this data, and according to my sources, and I'm talking to some of the supply chain people, and I'm talking to some of the people that sell accessories for Apple, and I'm talking to some of the Verizon and Sprint and AT&T and T-Mobile people, and I think Apple's only going to bring in revenues of $3.9 billion next quarter. And another analyst is going to say 3.5, another analyst is going to say 4.5, another, and every now and then there's these outliers that says, I think Apple's going to make $5 billion next quarter, and someone says, I think they're going to make $3 billion. And you've got this huge, you can at times have this big range of what one analyst thinks should happen and what other analysts think should happen. And you'll hear a term called the consensus expectation. So we have the one analyst thinking they're going to make $3 billion, and another analyst thinking they're going to make $5 billion. And this might be kind of an outlier, and this might be kind of an outlier, and you might have the bulk of analysts are somewhere between 4.2 billion and 3.8 billion, and you might have the mean be right at 4 billion, give or take a little bit. It's not always going to be halfway between the outliers. It's probably going to be the middle of where most analysts are at. And so you'll get what's called a consensus estimate. Now, they'll give these numbers for revenue. They'll give it for earnings per share. They'll give it for guidance. Analysts are going to put out all these numbers that they think a company should meet. And then a lot of times, whether a company's stock moves up or down has less to do with how much money they make and how much earnings per share they have. And it has much more to do with where did they come in on those numbers versus what the analysts were expecting them to. The reason I don't like analysts, not personally, I don't know personally a market analyst from a big bank or a big financial institution. But as a general thing, I don't like analysts because they all have access to essentially the same data, and rarely do they get on the same page. And I don't think it's fair that a company's stock price gets punished because a group of people thought they should make 4.2 billion and they made 4.13 billion. And somehow we think that's bad because it's not what the analysts thought it should be. And but you can't ignore it. As much as I don't like analysts, and you may not like analysts, and a lot of it is because we have enough information available to us now that we can be our own analysts. Why not let the investment community as a whole decide, is 4.5 billion in profit good or not good, because the analyst thought it should be 4.3? Well, that would be beating the street or beating the analyst's expectations. But I think 4.5 billion is good, even if the analyst thought it should be 4.7 billion. So you have to pay attention to what the analysts are saying, and it's a big part of earnings. And one of the last things I'm going to share with earnings is, this ties back around a little bit to fundamental analysis and choosing the companies that you're going to trade. Try to find companies that more often than not have their biggest volume, their biggest single day volume moves, and more often than not have direction changes, and more often than not they move in a fairly steady direction in between earnings reports, even if there are times in between that they have these little pullbacks and recoveries. Look for companies that have more consistency with, once they get moving in a certain direction, they continue that direction, and it's a good earnings report that has the ability to pull them out. Or if they're moving in a certain direction, it's a bad earnings that might knock them down. Here's a better example. You're not going to find any companies that have every quarter look like this or every quarter look like this, where it was somewhat steady through the whole quarter. That's not as common as the ones, but find companies that have a tendency to spend most of the quarter, if not all the quarter, moving in the same direction. These quarters that are flat like this, they're harder to call or trade. You're never going to find a company that doesn't have some of this. But look for companies that have less history of that and more history of earnings being what causes the turnarounds, and consistency of the same direction movement in between earnings report. The more often you find that, history has a tendency to repeat itself. What's happened in the past is never a guarantee of what will happen in the future, but it has a tendency to repeat itself. All right. Never lose track of when the next earnings report is. Don't be too directional on a company going into the earnings report. Okay? That's number one. Never own a stock through an earnings report without protective puts or a collar trade in place. Be completely aware of when those earnings reports are coming up. And learn from the past earnings information, but always remember that history does not guarantee what's going to happen in the future. That wraps up our class on earnings. Thank you for participating and for some good questions. Enjoy the rest of your day and the rest of your week, everybody. Thanks. Bye-bye.